Slide. Okay, you're good. Am I live? Okay, let's go then. Let's go. Okay, guys, welcome back from lunch. Hope you had a good time there. I'm trying to get some of these questions as I go here. Can you get your grandkids, or can you hire your grandkids or someone else's kids? Yeah, sure, Lori. Lori, you can hire your grandkids or someone else's kids. The same rules apply. It would be a tax deduction for you, and it would be tax free for them as long as they're under 17 years old. Right? Like your grandkids could work for the ice cream shop, and as long as they're under 17, it could get paid tax free up to $15,000 a year, be tax free if they set it up that way inside of it. So, the two gators on the microloan. You explain with Venture. I have the doubt of why. Samantha, I have the doubt of why the 2K interest on microloan example he explained with financial friends. I guess you have to explain what you mean by that, and I could try to help clarify for you what you mean by it. Happy to explain it to try to clarify that piece right there. I'm going to show you this real quick. So if you can, expand upon it, and I'll try to answer for you. Here's a piece I want you guys to look at from the tax-free accounts. So I'm going to show you how I invest out of the tax-free accounts, okay? Tax-free investments. I'm not saying you have to do this. I'm saying this is what I do inside of it. And remember, this is what you're talking about when I'm talking about you want non-correlated assets, okay? So I don't want my, again, diversification is something that happens at a later stage, but it's all based off of non-correlation assets is what real diversification actually is, okay? So when I look at it from my tax-free side, I have my solo right here, which is my largest account. I have my Roth here. Okay, what is it going to invest in? I have my HSA, which is probably is my second favorite account. What is it going to invest in? And I have my CISA right here. Okay, what is it going to invest in? So there's four main accounts you have here. You have your solo, your Roth, your HSA, and your CISA accounts. All those are 100% tax-free. We can do all kinds of cool stuff with them. HSA is for my family health, and it's the second best tax-free account out there, in my opinion. CISA is for your family's education, your children's education, 100% tax-free, how we build that inside of it. So these are all four different tax-free accounts that you can set up and grow out of. How I have mine set up and where they say invest at times. So broad stroke here. Solo investing mainly goes into the hedge fund, okay? So there's a hedge fund. So inside of the world of investing, for most contributors, they invest in what would be called mutual funds. So like just if you invest in Charles Schwab or any of those different companies, they're basically just putting inside of mutual funds and they let it ride. Like that's it. They put it in and it goes. Inside of the wealthy side, they play into what's more called hedge funds. And we do higher investing with hedge funds, not mutual funds. And in a broad stroke, when you look at hedge funds, it just means you're hedging your bet against something, okay? So here's what we know about the market, right? Just think about this. The market, the stock market does three things. Guaranteed, it does three things, okay? It goes up, it goes flat, it goes down. Does that make sense? The market is going to do three things. The market is going to go up, the market is going to go flat, and the market is going to go down. So just in the process of time, just look throughout time. It goes up, it's flat, it's down. Well, when you invest, say, like out of a mutual fund, there's only one way you make money, and that's when it goes up. So inside of a mutual fund, right, you make money when it goes up. But when it goes flat or down, this is a loss, and this is a loss. So there's three ways to make money here: up, flat, down. Inside of a mutual fund, you're making money one way, and you're losing money two ways, okay? So when the market goes up, you make money. If the market goes flat, you lose money. If the market goes down, you lose money. In a hedge fund, what they're doing is they're playing the game where they can make money. This can be a profit for them. They can make money here. They can make a profit here. And they can make a profit here. Now, there's different types of hedge funds, to be clear. There's different types of hedge funds that do different types of investing. So I'm specifically talking about the hedge fund that I invest in, okay? So inside of it, what we're trying to do is play a conservative approach, non-leveraged. So we're trying to not play risk side of games. We're playing, there's always risk, don't get me wrong, but we're trying to play less risk, meaning less leveraging our money out there. And inside of it, think about it this way. When this goes up, the word hedge right here is the word you're looking for. When this goes up, we make money. And when this goes up, on your side, you would make money. And the truth is, when you play the game of hedge fund like we were playing on that side, this side may make more money right here than, say, this side right here. Maybe it ends right here. And the reason it ends right there is because we also have stuff we're doing here and stuff we're doing here. A hedge fund structured the right way can make money when the whole point of it is to make money when the market goes up, it makes money. When the market goes flat, it makes money. When the market goes down, it makes money. Okay, this is the purpose of, say, a hedge fund that I would invest in. And that means that when the market is going up on this side, right here, same time as going up on this side may make more money. I'm gonna make up a number here, just strictly made up numbers here. Let's say this goes up to 17% right here, 17%. Maybe on this side, we only made 13%. Why? Because we have stuff here and stuff here protecting us. When the market goes down now, and down here you're at a 0% because it's a flat, you're not making any money. And right here you're down 13%. So here you're down 13%, here you're at 0%. But over here, we're up 4% now. We're up 4%, and now we're up 2%, up 2%. This is what a hedge fund is doing. They're hedging against the market because common sense says the market's going to go flat, the market's going to go down, okay? The market's going to go up. So making money on the upside is not difficult. That's just you bought shares and you let them ride, and the market overall goes up. What hedge fund is trying to do, in certain hedge funds, I should say, is trying to make money on all three of these right here so that this loss right here doesn't kill our portfolio. Because you got to understand, if you do the math on it, let's say that if your account goes down 20% over here when it's a bad market and it goes down 20%. If next year you make 20%, you're still not even back to where you were. Does that make sense? So here, you lose 20% right here in the market. The next year, you make 20%. You're still negative. So what a true hedge is trying to do is prevent this right here from ever happening, right there. Because it might take me 2 to 3 years to, when this happens, to finally get back to where I was before it went down, okay? So those 2 to 3 years of when it went down, and it took me 2 to 3 years to get back up, that's 2 or 3 years of me not making actual money. A hedge is trying to say that we're trying to make money. No matter what's happening, we're making money. We're not losing down here, like over here. We're not losing down here, and then it takes us 3 more years up here to get back to the break-even part. That's a hedge fund. The hedge fund that I invest with, to be clear, it was one of the last pieces of the puzzle that I tried to work on when I built this giant community that I built, was I brought the hedge fund into the community. But hedge fund investors only work with normally a hedge fund, you got to put $1 million in. Minimum investment, $1 million. Maybe 500 grand minimum investments, okay? There's hedge funds that the minimum investment is $100 million, minimum investment to get into a hedge fund. In this example, what happens is the government says, if you don't have, it's basically, they're saying, if you think about it this way, they're basically saying, go to full screen, Jordan. They're basically saying, if you do not have, because you don't have enough money, which tells us your financial IQ is low, we're not going to let you invest over here where the wealthy invest. So the government steps in and says, hey, your net worth is so low, we assume that means you don't understand money. Therefore, you can't invest on this side over here. It's basically, whoever just said it, Samantha, it's basically understanding accredited investors and non-accredited investors. So the government is saying is, with non-accredited investors, they're saying, because you're not worth a lot of money, you can't play with these games over here. Another way to look at it, I want you to look at it this way. Inside of mutual funds, think about it this way. Let's say that in the financial industry, as a stock as a whole. Let's say that there's 10 different strategies that you could use. So let's look at it as a toolbox, okay? Financial toolbox in the stock market. And inside this toolbox, there's 10 financial tools that you can use. A hammer, a wrench, pliers, okay? There's 10 different tools, financial tools that you could use. And those tools, financial tools, do different things. They don't all do the same thing. You can try to hammer a nail with a screwdriver, but it's going to take you a freaking long time, okay? Versus using the right tool, which is a hammer, to nail a hammer or nail a nail. So what happens is in a contributor's world, the government basically steps in and says, hey, listen, out of this financial toolbox here, because you don't have any money, which we would assume that means you have low financial IQ, like you're not financially smart, is literally, you can go look into it. It's the verbiage that they use. We're only going to allow the investors, your advisor, to use one tool in this toolbox. So instead of using the 10 tools they can use, because you're not going to understand those, we're only going to allow him to keep you safe. We're only allow him to use one tool in this toolbox. That would be like a mutual fund. That's what's happening. Inside of a hedge fund, what's happening is their government saying, oh, you have money, therefore we're going to assume you have a good financial IQ on your shoulders. So you can use all 10 tools. Your advisor can use all 10 financial tools here to make money. So one side is using 10 tools to make money, and one side is using one tool to make money. Why? Because the government said this side isn't smart enough to understand money, so we're going to protect you from your low IQ and only let you use one tool. And then the government said, because you have a high financial IQ, all right, you can use all 10 tools, it's fine by us. This is the difference between the two. The hedge fund that it's not my hedge fund, to be clear. This is a third-party hedge fund that has third-party audits of their financial documents. So this is a New York hedge fund, not a buddy of mine down the road invests money. This is a New York hedge fund out of New York City, Greenwich, Connecticut, where all the hedge funds are based out of. Hedge fund. The guy that runs hedge fund sold his first company to E-Trade for $151 million. Then he worked at a family office for, I think, 5 years, managing several $100 million at the family office for one person. That's a family office. Left, started his own hedge fund, last 13 years. The last 13 years, through third-party documented audits, has produced out on the hedge fund right here, sorry, wrong pen, has produced out 23.6% yearly returns, okay? 23.6% yearly returns for 13 years. That's what his annual average annualized rate of return has been inside of his hedge fund, okay? Now, listen, when you get into a game called Financial Friends, I'm going to tell you one of the key rules you need to understand. Anytime that you go and move money with anybody, I don't care who it is, anybody, your own mom, your dad, me, I don't care. If you ever move money with somebody, one of the first questions that I ask anybody when I go invest my money with somebody is, how much of your money do you have in that deal? Because remember, who cares the most about their money? They do. So when someone comes to me and says, Andrew, I got this killer deal I want you to invest in that they're raising money for, no problem. First step, before you tell me anything, I don't care about how good the deal is. I don't care where it's at. I don't care what it is. Let me just ask you one question. How much of your personal cash do you have in this deal? Not sweat equity, not appreciation. Nope, I'm asking you your personal money. How much of your personal green dollar bills do you have in this deal? And as soon as they start hemming and hawing and, well, yeah, you know, I'm really tied up right now. Listen, I'm out. I'm out. I don't give a shit. I'm out. Why? If that deal was so good, listen to me, if the deal was so good and they believed in it so much that it was such a great deal, they would find a way to put their money into it. And where their money goes, their focus goes. So I know if they have their money in it, they will be hyper-focused on that deal. If there's money is not in that deal and their money's over here, they'll focus over here, and this is a side project. And I never, ever, ever want my money to be a side piece. That makes sense? I want to be the main chick. I want my money to be the main chick, not the side piece. I want my money to be this main piece. So how do I make my money the main piece? Where's that person is trying to raise capital? Where's your money at? Is not that deal? I'm out. Because you're just trying to make my money a side piece while your money's over here, my money's over here, your focus is over here. If this goes good, you make more money. Yeah, I'm not looking for that. That's not financial friends. One reason I invest in the hedge fund with, his name's Jeff, the guy who runs all of it. One reason I invest with him is because 95% of his entire net worth is inside of his hedge fund. All of his investment, it's kind of crazy for him, but 95% of this guy's money is in his own hedge fund. Which, what does that tell me? It tells me he's hyper-focused on his money, not my money. He's focused on his money, what his money makes. If his money goes up, my money goes up. If his money goes down, well, my money go down. But where's his focus at? Where his money is at. So remember, it's like going to your financial advisor and saying, you want me to put all this money in this account right here. How much of your personal cash do you have in this same thing right here? Okay, well, why am I putting $5 million inside this thing right here? I put my money, when I invest in places, I put it where other people's, when that person that's raising money, if they got their money in there. My multifamily guy, his name's Carlos. He's a partner with us here at our family office. Same way. There's Jeff runs the hedge fund. Carlos runs all the multifamily, Class A multifamily. We bought, I don't know the number, probably close to 500 apartment doors this year. Okay, all Class A. In all those apartment doors that we bought, 95% of Carlos' personal cash is in those deals, which means he's hyper-focused on those deals winning. My cash, your cash, when you invest, is just going along with the ride of that person who's an expert in that field where his own personal cash is at. Because I don't have to worry about my cash if your cash is there. And matter of fact, like all your cash is there. 95% of your net worth is in that thing right there. You will hyper-focus on making sure that shit works, okay? So what I understand here, out of my solo, which is tax-free, where I put most of my money in my solo is inside of a hedge fund. Because I get 13 years worth of proof of 23.6% averaged out over the 13 years is what it's made out for me. My Roth side, so this right here is my Roth. My Roth invest in tax-free crypto. So I put, again, non-correlated assets here. I've got most of my money, if you ask me, I'll tell you anything you want to know. Most of my investment capital is tied up in hedge funds because I get great returns out of that shit. My Roth money, I put in crypto, okay? Non-correlated asset separate from the hedge fund, okay? The hedge fund is not investing in crypto. So I go to my Roth. There's a platform called taxfreecrypto.com. It's a website. It's a trading site, okay? I can go in there. I put my money in my Roth every year. My money, my mom's money, my dad's money, my wife's money. I take that money and I buy crypto with it in January. And then I hold it. That's it. I don't flip it. You could. I don't do that. I just buy it as a non-correlated asset. Every year, I buy about $30,000 worth of crypto. I've been doing that for years now. Every year, just in January, buy 30 grand of. I buy the main coins. Again, this isn't financial advice. I'm not telling you to do this. I'm just telling you what I do so you can understand it as educational purposes. I buy my crypto here. My HSA, I buy rare, collectible gold. Okay? Rare, collectible gold. Inside of this one, my HSA, to understand the HSA, married, you can put $8,500 a year as a tax deduction into your HSA, okay? I put in my $8,500 and I turn around and I buy rare collectible gold. Now listen, inside of where people get confused about gold at is you look at gold and sometimes you think gold is to protect yourself from end of the world. And if everything collapses, you own gold. And gold over time has gone up, right? In the last, 10 years or so, gold has probably close to doubled in value in the last 10 years so far. And it's like people use that as more of a security investment, low growth security investment. And you can, if that's what you want to do. It's not what investors are doing. It's what you can do it that way if you want to. I don't care. And do I have gold in my safe? Yes. Yeah, I have gold in my safe. But it's not my real investment, okay? When it comes to gold, I want you to understand this, okay? I need you to understand this. Inside of my HSA, I buy gold, rare, collectible gold, okay? There are 41 gold coins that have been dubbed as the 41 coins inside of Roth accounts that people invest in. They're gold coins, but they're rare, okay? I mean, there's no more of them. They're all like from the early 1900s, late 1800s. They're all graded coins. They've been verified that they're real. They've been tested, and then they've been graded. So they're graded, rare coins. Let me give you an example. I'm a collector of baseball cards, okay? If you have a graded Mickey Mantle baseball card that's graded at a level, number 10, level 10, they go to 1 to 10, 10 being the best. If you have a graded Mickey Mantle baseball card, I believe right now it's worth about $10 million, okay? Like people have paid $10 million for a graded Mickey Mantle rookie baseball card, graded at a 10. What is the thing that they're buying? I want you to think about this. What is the thing they're buying? Is it a baseball card? No. The investment is not a baseball card. The investment is rarity. It's limited quantity. So what investors, it's supply and demand, okay? So what investors are buying is the rarity of that card. The card is just a piece of cardboard. If you crack open that case and take away the graded number 10, and now it's just a piece of cardboard, the cardboard itself isn't worth any freaking money just as a piece of cardboard. What makes it worth $10 million versus the next piece of cardboard is because the rarity, the exclusivity. There's only a few of these in the existence of America. There'll never be another one. This is a rare piece. They're buying the rarity of the collectible of a piece of cardboard. That's what they're buying, okay? They pay $10 million for a piece of cardboard because of the rarity of it. Now, when you invest in gold, the way I invest in gold is I'm not buying just the gold. Go back to the hedge piece. Hedge is hedging your investment. So when something goes down, I'm hedging against the downside of the deal, okay? So when you're buying invest in gold, and you invest in rare, these 41 rare gold coins that exist, okay? There's 26 different dates of the 41 coins. Some dates have 2 coins to them, so that's why there's 41 coins, but there's only 26 dates that are in this categorization for the Roth IRA style investing. If you were to, listen to me, in the last 15 years, if I were to put the 41 gold coins on the wall right here, and you were to blindfold yourself, walk over to the wall, and pick one of them and buy it, in the last 15 years, the least amount you would make on those coins, if you pick the worst coin of those 41 coins, in the last 15 years, your profit was 16% interest. The best was 26% interest. Now, I want you to think for a second. See, the way that you play the game right now is you take money, because you're not the CEO of money. You're the CEO of your business, and you try to delegate wealth. So when you delegate it, you just give it to someone else, and as long as the market's going up, you're good. But when the market goes down, and it will, it's impossible, it always does, when the market goes down, you lose. CEO of money is understanding where I put that money at. It's how much I put where. All my money in those investments are tax-free growth. I can make all that money 100% tax-free. So I have 3 sets of non-correlated assets here. I have hedge funds making me, on average, 23.6%. I have crypto that I'm buying the main coins. I'm buying Bitcoin, I'm buying Ethereum, I'm buying Solana, and XRP. Those are the 4 coins that I buy inside of my crypto account. I buy them and just hold them. And then I take my HSA account, which is tax-free, and then I buy rare gold coins. The rarity of the coin is what's making the value go up. The hedge is the value of the gold. So let's say that, unlike a piece of cardboard, let's say that the rarity goes down, because it can go down, the rarity goes down. Okay, I still own the gold, which is the hedge. I'm hedging the loss of the rarity going down. I still own the gold itself on the coin. So I'm investing in gold, but I'm investing in rare collectible gold, not just an ounce of gold over here that I put in my safe. I invest in rare collectible gold coins that have the value, that hold the value of the gold ounce inside of them, but I'm buying the rarity of the coin itself, which is going up in value. The last 15 years, the worst The worst amount you'd have made on those if all those 41 coins was 16% interest while owning gold on top of it. So if you ask me, which people do all the time, where do you put your money? I'm not telling you to put your money anywhere. I'm telling you, as an educated investor that understands the game of money, here's where, as the CEO of my money, here's where I put my money at. The CISA account, this last one over here, is where I do small money movement. Okay, so this is $2K per kid per year that I can put in. Now, this is where I now begin to do small money movement. And my goal that year, so I say I put it in January. My goal that year is that I will quadruple that money this year. So I'll go from $2,000 to at least $8,000 to $10,000 this year on that 2K. And then I'll take that 2K and roll it into either gold, more crypto, or more hedge fund. So I'm going to do small money movement back and forth. 2K, I got 3K. 3K, I got 5K. 5K, I've got 8K. 8K, I got 10K. So from January to December, I do small money movement. And I try to get that 2K to like 10K by the end of the year by just doing small money movement with my financial friends, okay? Just in my own community. I just move it back and forth, 2 months, 3 months, 1 month, etc. At the end of the year, December rolls around. As soon as all the money comes back, I take that and invest it in either gold, more crypto, or more hedge funds. Those are where I put how I use my 4 accounts right there, okay? You say, well, what about multifamily? Multifamily, I buy my personal in the quadrants. I buy my personal, on the personal quadrant, that orange quadrant, I buy all real estate out of the personal quadrant. I say all real estate. I buy the majority of real estate out of the personal quadrant so I can get tax deductions for it. So I can buy a multifamily in my solo, no problem, or HSA, or CISA, or Roth. And my income is tax-free. But when you play the game the right way with structure, and you build out your structure to do what you need it to do, the 4 quadrants, if I invest in real estate out of my personal side, not my retirement account, but my personal side, then I get to deduct that money from my business as a expense, basically. Let's call it that for right now. I get to deduct that from my business income as an expense or a loss, if you will, while owning assets now, okay? So out of my personal quadrant is where I want to buy that type of multifamily or Airbnb real estate. I buy that on my personal side so I can get deductions from it on that side. So there's mainly 5 main investments that I make, okay? You can do whatever you want to do. I'm not telling you what to do. I invest in hedge fund. That's the main part of mine. I invest in crypto. I invest in rare collector gold. I do small money movements, and then I do multifamily Airbnbs as well in my personal account. Those are mainly the 5 types of investments that I will sit there and do. In my solo, I do private equity type of investments out of my solo account as well, as I'm building out my solo. So that's how I move my money in which of these accounts. There's 4 tax-free accounts. Then it's a matter of, Andrew, do I got to move money in all these accounts nonstop? No, I don't want you to get overwhelmed. I'm telling you this because you can simplify the process. Simplify, as a CEO of money, simplify the process just like you would in your business. You don't try to overcomplicate your business. You want to create SOPs, standard operating procedures. So all I did was create SOPs inside of my tax-free accounts. Understanding money, I put them in non-correlated assets so that if one goes down, all of them don't go down. Some might go down, but the others will go up inside of that. I'm hedging against that process to keep the money moving across the board there, okay? So that's where I put my different invested capital from what account. Solo means hedge fund. Roth means tax-free crypto. HSA means rare collector gold. CISA means small money movement. Personal account, personal investing means multifamily investing. And I want to show you something so you can kind of see this. Give me the iPad, Jordan, if you can. Move this over. Oh, you had me in the screen already? Sorry. Oh, excuse me. Man. This is the calculator while ago that I showed you. I want you to see something here, okay? I'm 42 right now, and we'll go to 62 years old. I want you to understand the power of your money working for you inside of accounts. If I take 100 grand right here, if I take this 100 grand, let's say it's all the money I have put together, and I take the 100 grand and I invest that 100 grand, get it to work. And I put 583 a month into it, which would be 7 grand, meaning all I do was put money in my Roth. So your entire retirement, you had 100 grand set aside, and then you put your Roth, 7 grand a year, which equals 583 a month, inside of it. I want to show you the difference. You can see what happens here. If I do this annual rate of return, how most people invest, and put it in at 7%, this right here is how it looks at the bottom. The average return of the last 10 years in a 401k has been 7%. You can look this up. It's public data. The average return of the S&P has been 11%. The average return in the last 10 years in our hedge fund, it was 23%, okay? That is a documented third-party audited process, okay? So inside of here, it has to be that to be able to get investor capital, it has to show the audit. So in a hedge fund, you would ask the hedge fund, any hedge fund, to see the third-party audits of their books to know that that what they're saying is accurate, okay? Them lying is jail time, to be clear, okay? So annual rate of return, if you do it at 7%. So if you do it at 7%, 100,000 at 7%, you would end up with $707,000 in retirement. So if right now you put 100 grand in, and then you maxed out your Roth every year, okay? Every year max out your Roth, $7,000, you would end up with retiring at $707,000. If you change only one thing on here, if you change this from 7% to 11% instead, so instead of just putting it in a 401k, you just took it and put it in the S&P, okay? Which you're making money up, but you're also losing money flat and down. But let's say you put it averaged out over the span, it makes 11% for you. If you do that instead, you'd have $1.3 million, almost 1.4. So I want you to understand something. In the game of money, understanding how to get your money to work, meaning it needs to produce for you. It needs to run. It needs to produce at a high level, because your money can outwork you if you let it. If you untie its hands and let it run, it'll run, and it'll outwork any of us. In this example here, at 7% towards 11%, same amount of money from you. You didn't change any more money or add any more time to it. What you did was got your money to work at a better job. Let's look at it that way. You got your money to work at a better job. Therefore, it went from 700,000 in that time span to almost 1.4 million in that time span, okay? In that exact same time span, if I change that to 23% and calculate that out inside of it, you'd have $12 million. Now, that's the difference between retiring wealthy and not retiring. Same amount of capital, same amount of money, same amount of time. 7 grand in your Roth a year. Start with 100K. What happens is it depends on how hard that money works. Now, as a contributor, all we're ever used to is what we've been talked to as a contributor, and how money works, and what type of returns we should go and get, and what type of returns we should expect on this side. Just understand, on the wealthy side, unless you think, I just want you to think about this, unless you think the wealthy are putting their money the same place you're putting your money. Now think that through. Do you think that's accurate? Do you think the wealthy are putting their money with the same person you're putting your money with? The answer is no. That is not what's taking place inside of it. Inside of it, the difference between retiring with very little money to retiring with massive amounts of money is understanding how hard your money works and why does it work. What's the benefit of it? What is it doing? How is it producing it? Etc. You're the CEO of your own money. You retiring with 12 million or you retiring with 700 grand right now is based off of your financial IQ. That's it. It's based off your financial IQ. You retiring with 700,000 or 1.4 million is based off of your financial IQ. You retiring with 1.4 million or 12 million is based off of your financial IQ. That's how it works. So for me, think about this. Inside of see if you guys can answer this question. Inside of my solo, how much money a year can I contribute into my solo? How much money per year can I contribute by law to my solo? Anybody know? In the chat bar? Yeah, Elizabeth, you got it. In my solo total would be 70,000, 46,000 on one side, traditional, but I can roll all of it to my Roth at $70,000. So watch. I don't know if this is possible for you because we're all different on here. In your business, can you, if you could you come up with 70 grand a year for your own retirement, okay? For your own retirement, let me see here. That would be, do some math here with you. What is 70, I'm gonna take 70 grand, divided by 12 is 5,800. Okay, so all I'm gonna do is I'm gonna take, and all you do is max out your solo, okay? So you maxed out your solo every year from 42 to 62. So you did your business, you maxed out your solo per year, you maxed it out from your business as a deduction, okay? And you maxed out the 70K, you started at 42, and every year you did it, and you did it at 7%. You retire with $3 million. That's not bad. I mean, you could probably make it off of that in retirement. Or you could put it at 11%, and you'd have $5.6 million. That's better. How many of you could retire with $5.6 million tax-free? Okay. Some could, some could not. If I do the exact same thing, which is what I do, and put it at 23%, it's $35 million. So when I hear people talk about, as an entrepreneur, I'm trying to create generational wealth, you're going to have to understand how money works then. Because the difference is how much, someone used the word up here, velocity, is the velocity of which your money is working for you. Now, let me get into your brain for a second. What your brain is telling you is that 23% is super risky. So as you hear this, most of your brains are going to tell you, man, making 23% is just way too risky. The point I need you to understand is, I would agree with you if we're looking at apples to apples. What that means is, the reason you're saying your brain is telling you, well, I wouldn't want to invest like that, that's too risky, is as a contributor, we've been told our whole lives that for us to be able to make that type of return, we would have to take a lot of risk over here. And that is true. That's true because for you to try to make 23% a year for 10 years straight in a mutual fund, my God, it would be extremely risky for you to do that. Why? Because they're only using one tool, which means it only works if it goes up. And the market doesn't go up for 10 years straight. It doesn't just, there's no bad days. No, there will be bad days. So what happens is, based off of what you've grown up with your whole life, what your brain is telling you is true. That if you had to make 23% over here, yes, that would be way too risky. But you're basing the data off of the information from a contributor side versus basing it off of the information from a creator side. That makes sense? There's a completely different shift into what's happening. One is hedging everything. One is just putting it into the market. I mean, this is crazy. You're paying people an insane amount of money. Go look at Jack Bogle, the founder of Vanguard. He died at 93 years old. When he died, he said, are you sure you want to keep investing this way? You put in 100% of the capital, you take 100% of the risk, and you get 30% of the actual returns. That's from Jack Bogle, the founder of Vanguard, the 6th largest wealth management company in America for contributors. And he said, right before he died, are you sure that you want to do this? Because let me explain it. This is his words, not my words. You're going to put 100% of the capital in. You're going to take 100% of the risk, but you're only going to get about 30% of the actual returns, which means if you actually add the math into what you're losing, what he's saying there to you, is you're losing about 70% of all your profit is going to go to the other company, the managing company. It's going to go to the company over here. So instead of understanding to understand what he's saying there is why when I say financial friends, when I say, let's see if you look at a hedge fund. If I'm at a hedge fund, I said, invest 100, what he's saying is 100% of your capital goes in. You put up 100% of the capital. Yeah, that's not true in hedge funds. Let me say, in hedge funds that I would invest in, that's not true. Normally, the person that has the most amount of capital at risk is the money manager, not the other investors. So when I play the game where the person that stands the most to lose is the guy doing the deals. That's where I put my money at. So that's why when Bob was saying, hey, look, are you sure you want to do this? You're putting your capital, 100% of your capital goes in, not the other person's. And a hedge fund is the opposite. The other person, the actual investor, is putting in their own capital into the deal. You're a tag along in their capital. They're the one that has the expert side that they're willing to put all of their money on the line. And if you want to tag along, tag along. But all of my money's in here because I'm doing this right here and I'm watching my money. Your money's just tagging along, bro. It's the opposite of what Bago was saying. And Bago was trying to wake up the contributors and say, hey, you got to stop doing this. Stop investing where you put 100% of the capital in. Come play where the real investors are putting in their own capital and you tag along. And then he said, you're taking 100% of all the risk. You're taking all the risk. On the creator side, we don't want to take all the risk. When we move money in different things, we're moving with financial friends so that we can not eliminate risk. There's no such thing as eliminating risk. But we're building moats, if you will, around the risk to mitigate the risk that we're trying to take. What he's saying is, if you lose, the market goes down, you lose. And that's it. You just lose. There's nothing else to do. You have no hedge. You're just losing. And the last one is, you're going to make 30% of the actual returns, which means the company is going to make 70% of the actual profit. Over time, that company produces 70% of all the profit. It goes to them. 30% goes to you. It's why, hear me out, it's why there's generationally poor families and generationally wealthy families. That's it. Because your money's going to work, but because of not understanding it and focusing on something else, your money can only work at a 30% growth. That's not 30% growth per year, but a 30% of the profit goes back to it. You're losing out on 70% of the growth that you should be getting, that your money got, but someone else took it. It's like saying there's too many hands in the cookie jar, and your hand's the smallest hand. So after all the hands come out, you get what's left over. That's the typical way to invest on this side over here. Over here, when I invest, I'm looking for non-correlated investments that are hedging what I got going on. So solo, hedge fund, over here, Roth, tax-free crypto, HSA, rare collectible gold coins. This right here is made out 16 to 26% a year for the last 15 years. That's what it's made out, okay? And the small money movement at December of that year, whatever year that is, call it 2026. At the end of December 2026, I'm going to take that money and roll it back into either a hedge fund, gold, or crypto, okay? That is my overall strategy when I go to invest inside of my tax-free accounts that exist, okay? If you want to do it different, do it different. I'm not telling you that I'm 100% right. I'm telling you with all the stuff that I know of how I do it, this is how I do it, okay? You can copy it, you cannot copy it, doesn't affect me because your money in your account is yours because you manage it. You make the decisions of where it goes, okay? It doesn't affect me where you put it, it affects you where you put it. You're in charge of your money, okay? Now, let's go back to the 4 quadrants for a second. Jordan, can you pull up the 4 quadrants and then go back to this slide right here real quick? Give me the 4 quadrants. Inside the 4 quadrants that we were looking at before lunch today, when you look at these 4 quadrants, a while ago I covered this quadrant right here with you, which was the solo side and the retirement side, which is the tax-free side of what we're trying to do, okay? So here you have your tax-free side, which is your solo side that you're investing with. The solo, now we have this, we can now move into this right here. When we move into this right here, we can now pay our lifestyle that we want, and we can shift the money over into all of our retirement on this side over here, okay? So let me show you how you do this process right here. I'm going to move from retirement into business. Give me the slide deck back, Jordan, to where you had it a while ago. The hotel fig. If you want that calculator, just text your people and then get you the calculator. I'm waiting for that list of lenders. My guys are building it out right now, and then I'll get you that list of lenders as well. Let's see here. Okay, here we go. So we're going to go to the business side, and we're going to go up to the floor 20. This will be like the top floor of the overall hotel fig right here, because this is what's going to create the structure, whether you're doing a little bit of money in business or you're doing $50 million in business. It's the structure that determines the rules of the game for you, okay? So here on this floor, we're going to go into this one main piece right here, which would be the business side of things, okay? The business side, or the, pull over there, this business quadrant inside of it. Give me the slide deck now, Jordan. So inside of the floor 20, you have a concept called ROBS, R-O-B-S, ROBS. It simply stands for Rollover Business Structure. It's the most powerful structure out there that exists. There's not another structure. So if you're thinking, well, later, Andrew, you're going to cover a different structure that's more powerful. The answer is no. ROBS is the most powerful, best structure out there that exists. It is built from this guy right here, Peter Thiel, who perfected this process when you go back to Forbes, and he invests $2,000 into a $5 billion tax-free kitty, even though his account jumped more than $3 billion in just 3 years, even though he didn't contribute any more money to it in his Roth from after 1999, which means he only put in $2,000, but somehow ended up with $5 billion. That is a great freaking investment. $2,000 in 3 years is $3 billion, okay? How did he do it? Did he put it with a financial advisor? No. It's not what he did. He took out, in this process, he did what I'm going to show you here in the ROBS. He was the founder of a company called PayPal, okay? PayPal. And when he founded PayPal, understanding structure, which is what the wealthy understand, he didn't just go form PayPal and say, well, PayPal is going to be an S-Corp, and whatever happens, happens. That's what we did, because we don't understand money. So we just said, well, structure is just an S-Corp. My CPA said it's an S-Corp. I'm a startup business, and they said it's an S-Corp. So that's what we go do. Right. Well, there's a difference between wealth and non-wealthy, okay? And wealthy understand structure, okay? So inside of here, he opened up what's called, he started PayPal. He didn't open it as an S-Corp. He opened it as a ROB structure, where his Roth account bought the shares of his PayPal account. Matter of fact, you go look it up. They bought 1.7 million shares at 0.001 of a penny. So when he started this, okay, that was before, listen to me, it was before PayPal was worth anything. So this idea of the way that wealth is created is I build my business, and then once my business creates me all this money, then I start doing shit. Is not true. That's lightning in a bottle. You're hoping for a magic wand to show up. The way that wealth is created, I say this all the time, wealth is engineered. So money can be earned, but wealth is engineered. So what happens to entrepreneurs is you're making money, you're creating money, your money is earned, you're earning the money. You have never engineered any of your wealth whatsoever. Therefore, once you create it, money, you have not engineered anything past that, minus I create it. That's all I got. Wealth is engineered. You have to on purposely, you have to understand it so that you can set it up the right way. And if you don't, well, then you'll stay where you're at. If you don't engineer it, no one's going to do it for you. No magic fairy's going to knock on your door and be like, hey, we need to engineer this the right way. No, that's never going to happen. You have to do that. When? At the beginning. He did this before. He didn't build it and it went public and then he bought it. That's illegal. It's illegal. You can't do that. He bought it when it was nothing. That means his financial IQ was high enough to know that I'm going to build this, I'm going to set it up as a C Corp, I'm going to have my Roth buy it so that it's tax-free for me for the rest of my life. And then I'll build the company. That's not what we do. We don't do that. We build an S Corp and just hope for the best. And then every year we're trying to go to zero somehow because we have no structure. So inside of this, remember, structure happens at the beginning, not at the end. If you wait to the end, it'll never happen because you'll never get there. You can't go to zero every year and create wealth. It's one of the two. Go to zero every year, don't create wealth. Or structure the right way, still don't pay taxes, create wealth. In both sides, you'll get out of the tax side that you're trying to get out of. One side you become wealthy, the other side you will not become wealthy. You can't. You can't do it that way. So inside of here, my main point I want you to understand is this all happened, to prove my point, before PayPal was anything, okay? That means his financial IQ was high. Financially IQ people make a shit ton of money, okay? ROBS is the structure he used. ROB stands for rollover, R-O, rollover business startup. Rollover business startup. Inside of the tax code is IRC 4975. IRC 4975. IRC 4975. Again, it stands for rollover business startup. It's an account. It's not an account. So solo Roth, HSA, CISA, those are accounts. A ROBS is not an account, okay? ROBS is a tax structure that they use. ROBS is a tax structure that they use, okay? You say, Drew, can I go set this up? You cannot. You cannot. Nor could I. Nor could I. And I know a lot about it, but I couldn't go set this up. You're going to need several people to set this up. It costs a good amount of money to set one up. Okay, it's not like you're going to go to LegalZoom, click on 2 more buttons, and click on a special box, and voila, you have a ROBS. It doesn't work that way. A ROBS is a specialized, high-level, from the wealthy side, tax structure that they use. Matter of fact, I would be willing to bet you that 95 to 99% of the people, if you went and asked your CPA on Monday, can you open a ROBS for me? They're not going to know what you're even freaking talking about. A ROBS is a specialized product that exists on the wealthy side of how we build our businesses to always win financially for us, okay? So inside of a tax structure called ROBS, number one, inside of a ROBS, you have to take a W-2 salary. So again, it goes against everything that you think of how it's played, because a ROBS, legally, you have to take a W-2. There's no way around that process. You have to take a W-2. You're going to need several items to create a ROBS structure. I'm going to show you, draw it out for you so you can see it, not because you're going to go do it. This isn't a DIY project. This is an expensive project. To open a ROBS up start to finish is probably around $10,000. To open a ROBS up all the way through, by the time you actually get all the paperwork done, actually make all the filings, not just your initial consultation fee. Like by the time you're all said and done, when it's all completed, you're probably going to be around $10,000 to open up a ROBS structure. And it's probably going to take you 6 weeks to open one up. It's not a quick thing. You're going to have to hire ROBS attorneys. To be clear, I know of 4 ROBS attorneys in America. Okay, this isn't something you're going to go call your brother's uncle who's an attorney and tell him to set up a ROBS structure for you. Think about tax structure as a specialized thing, just like doctors are, just like attorneys are, okay? So as a doctor, let's say you need heart surgery. So there's specialists that are doctors, but they're specialists and they're heart surgeons, okay? But your doctor is also a doctor. So you could, if you wanted to, go to your local doctor, your family doctor, and lay on the bed and tell him to cut you open and give you triple heart bypass surgery. You know, the same way that he was working on the kid that had a sore throat and gave them some amoxicillin, he could then come over to you and cut you open and do a heart surgery for you because he's a doctor. So, you know, it's all the same. What I'm trying to tell you is it's not the same. There's specialty pieces inside of actual money that you're going to have to understand. Just like there's specialty in everything, okay? So inside of tax structure, as I'm what they call a tax architect. So inside of tax structure, we would use different tax attorneys that specialize in different things to build what we need. So there's attorneys that are called ROBS attorneys, meaning their specialty is ROBS. They don't do ROBS, and they also do divorce court or bankruptcy or criminal attorney work. No, they just do ROBS attorneys. That's what their specialty is. There's 1202 attorneys, and their specialty is 1202 structures, tax structures for wealthy clients. That's what their whole firm is about. How do you do 1202s? I have a 1202 attorney, and I have a ROBS attorney. They're not the same attorneys. Both of them are freaking geniuses in their own rights, but they do 2 different structures. And the 1202 attorney doesn't try to do ROBS, and ROBS attorney doesn't try to do 1202. But they're both high-level tax attorneys, but they specialize in different things. At the level when you're trying to create wealth, that's how it works. Just like you would have a heart doctor and a doctor, in wealth, it's the same thing. I'm using the example as the attorney side. So here's what you'll need. You're going to need a previous 401k. You can write this down, and then I'm going to draw it out for you so you can see it. This would be the greatest structure that you've ever seen for business in your life that will solve the problems that you're having with money if you'll run it this way right here. You're going to have a previous 401k, number 1. You're going to have a ROBS tax attorney, number 2. There's 4 in the country that I know of that do what we're talking about here. There's some other ones that will do a ROBS, but they do it for franchises, not what you're looking for. You're going to need a ROBS attorney. You're going to have a self-directed custodian, okay? So you're going to have a self-directed accounts. You have what's called a custodian. So wealthy people don't have financial brokers or financial advisors. They have what's called financial custodians, okay? You're going to need a financial custodian to do this, and you're going to need a brand new C Corp, inside of here, a brand new C Corp. You say, Drew, I already have a C Corp. Perfect, we can't use it. You say, Drew, I have a C Corp that I never used. Perfect, we can't use it. You say, Drew, I'm going to go to LegalZoom and open my own C Corp. Perfect, we can't use it. Okay, so listen, Rob's is a high-level strategy game. That's a tax structure that you pay for it to be set up right. It's not this half-ass DIY shit. If that's what you're looking for, don't do Rob's. Rob's is a fine-tuned machine that has to thread a needle in what's called self-dealing. So it's why you pay to get this built. I can't go build it. It's again, the way I describe it, it's like if you're trying to get heart surgery, you're like, no, I'll just do it myself. Okay, perfect. Then stay away from me, bro, because it won't work, and I want nothing to do with that concept. Inside of 1202, it's like, I'll go open my own 1202. Good freaking luck. Good luck. Go do that shit. Just don't get near me, bro. Inside of here, you're going to need a new C Corp, okay? And then you're going to need a company 401k plan, okay? So you can write all those things down. You're going to need all that shit. I'm going to show you how it works. I'll draw this out for you so you can understand it. You're going to need several pieces of paper right now, and I'm going to draw out so you can see the flow of money as we build it and make it work. Give me the board here. Okay, so I'm going to draw a couple pages here for you so you can see and understand the total flow of all of it. Number one, you're going to have on this side right here, I'm going to put the word solo 401k. In your notes, if you want to put down, you could have a traditional IRA, a previous traditional IRA, or a previous 401k, that can go there. I'm putting a previous solo 401k because if you're on the call right now, the training, and you're like, I don't have a previous 401k, so can I not do this? The answer is yes. What you're going to do is what I did. I didn't have a previous 401k. I went and took my LLC, that's a business, and I went and opened a previous solo 401k. So now I had a previous solo 401k, which qualifies as a 401k. It's a solo 401k. Now you have it. So if you want to do a Rob's and you don't have a 401k right now, don't stress. Open a solo 401k, on Monday, and it'll be open by whatever, Tuesday to be open, and now you have a previous solo 401k, all right? Then the attorney that you hire is going to open up a new C corporation for you. They'll do the whole thing for you. You don't have to do any of this. I'm just showing you how it works. Once you have the C corporation open, they're going to open up a new company, solo 401k here. So for a second, you're going to have two solo 401ks. You're going to have this solo 401k, and you're going to have this solo 401k. This one right here is going to your old LLC. So it's attached to your old LLC that you have or your previous company. This solo 401k is attached to this company. So this one, it belongs to this company over here. These two go together, okay? Now what you're going to do is the first two letters up here, which are RO, roll over. So inside this solo 401k, inside of our Roth component of this account, let's say that we had inside of our solo 401k Roth, let's just say that we had $20,000 inside of it, okay? We're going to roll this money into this account right here, okay? So now, in this solo 401k Roth compartment, Roth hat, we now have $20,000 in it, okay? So once we do that, we just completed the first RO rollover from our old solo 401k into our new company solo 401k Roth hat. Okay, it has to be the Roth. You can't do a straight Roth to a Rob's. You have to do a 401k that has a Roth component inside of it, not a straight Roth. Okay. Now that we have this, now we're going to do the next section, which is the BS side, which is the business startup side. So now we're going to make this investment into here. So let's say the investment is $20,000. In return, I want something. What do I want? I want shares, okay? I want shares. Now, who owns this new C corporation? Who owns the corporation? This would be you. You own this corporation right here. You are a 100% owner of said corporation, okay? So the C Corp belongs to you. You're a 100% owner of that C corporation. You own all of it. It's all yours. But you as the owner are looking for investors, let's say, to invest with you. And one investor that you spoke with was this person called Mr. Solo 401k Roth. That's an investor. It's not you. Now, again, this is why asset protection works in a solo, which is why there's bankruptcy proof, creditor proof, and judgment proof, is because it's not you. It's a twin of you, but it's not you. That's been established in court for many, 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 many cases, that a solo 401k, a Roth, those accounts are not you. They're a third-party extension of you. If you really get into it, they're actually a trust. When you open them up at a custodian's office, they're actually opening up a trust account for you, proving that it's not you, it's separate from you, okay? So although you manage that solo 401k, it's not actually you, it's a separate entity, if you will, trust, that's not you. So it's basically like two versions. There's you that owns the corporation, 100%, and there's you that manages the solo 401k Roth. And now you're going to negotiate with yourself. That's what's going to happen. On one side, as the company owner, you're wanting the company to raise this capital of $20,000 and give the least amount of shares to the investors. On the other side of you, the manager of the solo 401k Roth, you're wanting to make an investment of $20,000 in this C corporation, not an S corporation, but a C corporation. And in return, you want as many shares as you can get. So one side of you wants the least amount of shares. The other side of you wants the most amount of shares. And you have to go negotiate with yourself. That's what you got to go do. Now, after you think that would be easy, but if you're like me and you have lots of ADD inside of here, then shit. It's very difficult because I would negotiate from the owner of the corporation, and then I'd negotiate as the manager of the solo 401k, and I would go change outfits. I put a new outfit on. I'd sit across the table for myself and change outfits and come back and negotiate with myself. That's what you get to do when you have ADD as an adult. Super fun, man. Super fun. All that to say, at the end of this crazy negotiation with myself, I ended up agreeing that my corporation would give up 98% of all the shares for, let's say in this example, $20,000. You say, Drew, why didn't you give up the other 100% of the shares? Because you can't legally. If I could, I would have. The max amount you can, in this scenario, in a Roth structure, do is 98% of the shares. So I gave 98% of the shares from my C Corp to my solo Roth as an investor. I should say gave. I agreed in the investment structure that for this $20,000, let's say, it could be $5,000. It could be Peter Thiel did $2,000. He actually did $1,700, to be clear with you. He did $1,700. So it doesn't have to be $20K. Ignore the $20K. It could be $1,700. It could be $3,000. I've done a Roth for $3,000 just recently, maybe 4 months ago. I did another Roth structure, and I did it for $3,000. I did other Roth structures for $25,000. So I'm not telling you what the number is. That's really between you and the attorney. I'm giving you an example here, okay? So don't get stuck on the 20K. What you can't get stuck on is you want the 98% shares. That piece you can get stuck on. I want the 98% shares of the company there, okay? So now what happens is my corporation, 90% of the shares belongs to, for that C Corp, belongs to my solo 401k Roth side. The Roth component is tax-free, all right? So now this is the original structure. Now let's go to work, okay? So let me show you what it looks like if I draw out my own personal structure here. So again, this is for a Rob structure, okay? So it looked like this. Here's my C Corp, okay? This is a C Corp that I have. Over here, I have my solo Roth, okay? So I'm going to put solo Roth right here, okay? And this solo Roth invested here and here, 98% of shares goes here, and we said we did a deal for 20K like this, okay? Over here, this is me, and I own 100% of the company equity I own. So I don't have to ask for permission to do anything. I own 100% of the company. I have investors who own shares of the company, just like the Walton family owns Walmart, but you own shares of Walmart. But they don't come and ask you about what they can do at Walmart. They own Walmart, but you're a shareholder in Walmart as an investor in the stock, okay? Same thing here. Inside of it. It's just a private company that we're doing this with. Now, below here, let's say, I now have different LLC structures below here that could be all kinds of different companies that I own, okay? So my C Corp doesn't have to own just one company. It can own all kinds of my companies, in which case it does own all these different LLCs. So I have one C Corp now that is a Robs-based C Corp that 98% of the investment shares belongs to my tax-free solo Roth. Now, this C Corp owns many, many other businesses underneath it, okay? So for me, I'll give you like real life examples. This right here, let's say is Aspire Tour right here. So this is Aspire right here, and this is Aspire Wealth right here, okay? And this is Aspire Real Estate right here. This is Checkmate Taxes that we own right here, okay? This is, say, Empire that we own right here. Okay, so we own all these different companies, more companies than that, but we own all these different companies underneath this one C Corp that we have, okay? Now, these companies go to work, okay, and they do their business. Up here, I'm getting paid a W-2 salary. This goes into my orange quadrant. So in this example right here, let's say my W-2 salary on this side is $500,000 a year salary out of my C Corporation, okay? So my C Corp is paying me, in this example, a $500,000 a year salary. These different LLCs below it, I'm not getting a salary from those. If I wanted to, I could, but I'm not. But the profit at the end of the quarter will flow up into the C Corp right here, okay? So now all the profit flows up into my main C Corp at the top, okay? So let's say, for example here, let's say that this C Corp right here, when this profit flows up inside of it, let's say that this C Corp now makes a profit of $1 million, okay? Now remember, I want you to understand this. This is important to know. Inside, give me full screen for a second, Jordan, backstage back here. Inside of this structure right here, okay, which is my tax structure side. Inside of this right here, this is my tax structure, which this over here is tax deductions, okay? This is tax deductions, this is tax structure, this is tax-free, this is tax planning, okay? Over here, I want zero if possible, which is not, but I'm going for no deductions right here. I want my business, opposite from you, I want my business to make as much money as humanly possible, okay? I'm not trying to take my business to zero. I'm trying to take my business to as much profit as humanly possible. Now listen, in this one thing alone, you could have a massive breakthrough in your business. You see, because you spend half of your brain power trying to create money. And then you spend half of your brain power trying to get rid of your money. So when you see people that actually from the process come and do Rob structures with us, time and time again, you see immediate growth in their business. Because for the first time in your entire business career, you no longer need to worry about tax deductions. You no longer need to worry about, is this a write-off or not? The answer for you hopefully is no, no, no. Because you want to make as much profit as humanly possible. So now your brain power inside of your business structure right there is 100% focused on one thing, you making money. And for the first time, you're not trying to lose money, you're trying to make money. How much? As much as you can. What deductions do you need? Zero. None. I don't want any. Will I have some? Yes. Okay, so this room that I'm in, this virtual room right here that I'm in, that's a deduction. It's a real deduction. I have TVs on the wall. There's lights all over the place over here. There's microphones, AV, an LED, a curved wall behind me. Okay, these are real business deductions, okay? So you're going to have business deductions. That's for sure. But what I don't want is your 6,000-pound car. What I don't want is all your meals that you're trying to write off. What I don't want is all your business trips that are not business trips that you're trying to do. I don't want any of that shit. I want as clean as possible, true business expenses only process so that I can make as much profit as possible. Why? Because my profit, number one, it pays me a salary. If I want more, I could increase it, but it pays me a salary. Number two is because I'm going to take my profit, I'm going to pay taxes on my profit, and then I'm going to take my profit and shift it all to my retirement, 100% tax-free, to continue to build massive wealth in my life, okay? So watch. What's going to happen now in my, in this side, let me show you this right here. In this side right here at the top, what I'm doing is this right here is paying, right here at the top it says W-2. This company right here is paying me right here in this W-2, a $500,000 salary right here. This is how I pay my bills. I use deductions here to go to zero, but this right here pays me this right here. Now, this now has a profit. It owns all these different companies. They all flow up into this company. This now has a profit. Now, this is a C Corp not an S corp. This is a C corp, which means at the end of the year, the C corp, let's say it makes $1 million, and I don't want any deductions, so it makes $1 million here. It's got to pay taxes, but when it pays taxes, it doesn't pay like an S corp. It pays a flat 21% tax bill. So whether I make $1 million, $100,000, $5 million, or $1 billion that year in profit, I'm going to pay the same tax bill flat over and over again. I'm going to pay 21%. That's what I'm going to pay, period. So this is why it's funny, because a piece of this is funny because I say it's funny. It's not funny, but it's unique. Private clients come in here. A guy I talked to last night called me, schedule, I want to come in. I got these 5 dentist practices, and I'm paying over $1 million a year in taxes, okay? So just understand. I said, well, how are you structured? First question I want to know is, tell me how you're structured. Oh, I'm structured as an LLC S Corp. Okay, so just understand, that's going to put you right away at about a 40% tax bracket, okay? So when you're making that much money, you're before state, you're at about a 40% tax bracket. So if all you did was drop that to a C Corp, just understand, you would cut your tax bracket in half. Now your tax bill would be 21% versus 40%, okay? If you just did a C Corp alone. There comes a point, just remember this, every company that you personally have ever invested in through the market is a C Corp. There comes a point where a company moves from an S to a C, or they're gonna pay double the percentage in taxes forever. So at a logical point, any company that's making too much money would move to a C Corp to eliminate half of all their tax bill, okay? Now, better than a C Corp would be a Rob structured with a C Corp, because now at the end of the year, when your profit is paid out, your taxes of 21% is paid, all of that leftover profit belongs, or could belong to, if you want it to your investors. It just so happens that your investors is your tax-free account, which is what Peter Thiel did. So he said, oh, okay, hey, I got 21%, I got $100 million here. I got to pay 21%. So for easy numbers, I'm going to call it $200,000 here. I got to pay $200,000. Therefore, right here now in my company, I don't have $1 million, right? Because I paid out that money in taxes. So now I got $800,000. Okay, I paid out my $200,000. I get $800,000. What can I do with the $800,000 now? Well, I could pay that money to my solo Roth now, and now my retirement account has $800,000 inside of it. So just to be clear, if you think that wealthy people are playing the game of $7,000 a year in their Roth accounts, you would be sadly mistaken of how wealth is created. What wealthy are doing is using a Roth structure to buy their own company shares with their solo Roth, which is tax-free forever, bankruptcy proof, this one right here, bankruptcy proof, creditor proof, tax-free, passed down to my children, and they'll pay nothing in taxes. This was year freaking 1, okay? So every year now that happens, this money keeps flowing up into here, and it keeps moving from here to here. It pays out, and then moves over. It pays out, and then it moves over. Oh, this is going up here, pays out, moves over. This is how the wealthy start level 1 of putting so much money inside of tax-free accounts and passing it down. Again, now I want you to think about one simple thing here. When I do this, okay, right here, when I do this, now this money's in my solo, and I put that into, let's say, a hedge fund that's making out, let's call it 20% a year. Why don't you do the math on the calculator that I sent you, and you'll see what this is freaking worth in life. Instead of me taking all the deductions and going to zero, make sense? Just do this right here. Make my $800,000 over here, invest it in a process like the hedge fund that you're making 20% on. I'll make it easy for you. I'll take you all the way down to 10%. Let's do 10%. What you're going to find out is money right here can work way harder than I can work. What I'm doing is creating a structure that dictates where the money goes and why it goes there. And I'm getting into tax-free accounts. Now, if I want to make more money, can I make more money? Yeah, I can pay myself more money. It's not a big deal. I can pay myself more money. I can pay myself as much as I want to. I can take a loan for my company out that's tax-free if I want more money. Again, I haven't got to the personal side yet. I have a company on the personal side that makes me more money. That's on the personal side, my S Corp, so I can take it down to zero. I can pay myself more in here. I can give myself bonuses in here, but I'm doing this so I can create a structure that allows me to put this money year by year by year inside of here. Watch this. What happens when I sell the company? Okay, so let's say that when it's all said and done, let me do this first. Let me show you this piece right here. Okay, so here's how the game is actually going to play out, so you can see it. I'm going to draw a line right here, as though it's page 2. It's really the same thing, but I'm just gonna. I want you to look at it as page 1, page 2 for a second. This is just a miniature version of what I showed you. Looks like this, and then this has all these different LLCs to it. Okay. Over here is this solo right here. Looks like this. This right here is the same solo, okay? So these are the same solos. They're not 2 solos. It's just page 1, page 2, same solo from the account. So here's what's going to happen. I'm going to take this money right here. This money flows up into this right here, okay? I'm going to pay out my 21% over here. Now let's say I got $1 million left in here. It comes over here. I got $1 million inside of here, okay? Now this money drops down to here, and I got $1 million into here. Now, when this $1 million goes into here, what do I have to do? I need to move that money because I'm the CEO of money. So my structure, which I'm not the CEO of that company, to be clear with you guys. I'm not the CEO of that company. There's other CEOs. They run the company. I run my money. That's what I do, okay? So when money comes here, I'm the CEO of this. Now I got to move this money movement. Remember, money movement. So I'm going to move this money, and I'm going to make these different investments. I'm going to invest in some, whatever, car washes over here, and let's say I'm going to invest in multifamily over here, and I'm going to make investments in a hedge fund over here, and I'm going to buy some other businesses over here, like this, okay? I get the money out to work. Now, for the sake of illustration, this money, throughout the process of the year, it comes back in to my account. When it comes back in, it's 100% what? Tax-free, yes? So this is all tax-free. So let's say it comes back, and now I got $2 million. That $2 million is 100% tax-free. For the rest of my life, no matter what money it makes, I pass it to my children, it's going to be tax-free, okay? Pass it to my wife, tax-free. Pass it to my children, it's tax-free, okay? Now, what I got to do with the $2 million? The $2 million came in. I got to do something with the $2 million. I got to move it out again, and I got to invest in more opportunities. But before I do that, up here on this top side, more money came in for my business that same year. And this year we had a bigger business, and so this time it kicked out not $1 million, it kicked out $5 million over here. $5 million comes over here. I don't have $2 million. I actually have a $7 million investment now that I got to do. What I got to do? I got to move this money, okay? So I got to go move this money. I got to buy more businesses here, more multifamily here, more hedge fund investment here, more businesses down here, more gold over here, okay? Now, that money that was $7 million begins to come back in, comes back in, comes back in. Now I don't have $7 million. Now I got $9 million. But that same year when that was happening, my business up here was making me money up here, which tipped it over here, which sent it down to over here. And now I didn't have $9 million problem over here. Now I had a $12 million problem over here. And what will happen that year? I will send that money out, send the money out, send the money out, send the money out. All this money is 100% tax-free. The money comes back in, back in, back in, back in. Now I have $20 million over here. But that same freaking year that was happening up here, my money was moving up here like this over here. And it was coming back over here and then down back over here. And I didn't have $20 million anymore. Now I had $31 million problem. And you're not going to believe what I did with $31 fucking million. I moved that shit again, moved it again, bought more assets. Those assets came back in, 100%, 100% tax-free. There's no money, no taxes on any of that shit I'm making now, okay? Now I don't have a $31 million problem. I have a $54 million problem. And that same year that I made $54 million, up here at this top section, it was all coming back in, over. We sold the company. Here's the cool shit. When I sell the company, and I'm all done with it, and I sell it, when I sell it, I don't even have to pay the 21%. When I sell the company, the whole conglomerate off, 0% tax when I sell the company. I only have to pay taxes, 21%, on the yearly income that I make. When I sell the whole company off for God knows how much money when I sell this company off, it is 100% tax-free, and all that money flows in here. Let's say I sell this company off when I'm all said and done with it in 20 years. Let's say I sell this company off for $1 billion freaking dollars. When I sell the company for $1 billion, just understand, I'll pay 0% in taxes. My retirement will make $1 billion right here. This account right here, if I sell it for $1 billion, will now be sitting at $1 billion freaking dollars 100%, 100% tax-free. The money in this account right here is bankruptcy proof, judgment proof, and creditor proof. It's tax-free to me, it's tax-free to my wife, it's tax-free to my kids. And all of it's asset protected. What was your plan? Go to LegalZoom and set up an S-Corp? And then just deduct 6,000-pound cards every year and never have any money? Listen to me. The game that the wealthy play and the game that the contributors play is not even close. We're not even remotely in the same freaking ballpark of structure of what the wealthy do versus what the contributors do. If you stay in your structure, you are doomed for where you're at. There's no way out. It's a rat race. It's a loop to always go to zero. You know how you say, entrepreneurs will say, man, thank God I don't have a job because they're living in the rat race. No. Entrepreneurs are living the rat race. You're living in the rat race. I was living in the rat race forever, thinking, man, this doesn't make any sense. There's got to be a way out of this shit. I'm always going to zero nonstop. No matter how hard I work, I'm at zero. No matter how much I produce, no matter how much I reinvest in the company, I'm always at zero. Until I realized, wait a second, there's something I'm missing here, man. There's something that I am not figured out inside of structure, taxes, something I'm missing. 15 years of my life I've dedicated to figure this shit out. Little by little by little. For 15 years I put this stuff together until I mastered it. Wealth is injury. I now get paid $250,000 a day. You understand that? $250,000 a day to sit down with people and build all their shit out for them. Why? Dude, I'm an expert at tax architect. You say, my God, could you imagine paying $250,000 a day? Yeah, no, they're happy to fucking do it. Why? Because they have $1 million a year tax bill. So you got to understand perspective. If you're looking at it from who would ever pay $250,000, my answer would be not you. So don't worry. It's not you. Who would pay $250,000 a day to sit down with me? Is the people paying $1 million a year saying, I got to pay $1 million this year, next year, the year after, the year after, the year after. I got to find a way to solve it. All right, they come to me. And I can solve it for them. Through strategies? No, through structure. Structure first. Structure first. Strategies come second after structure is in place. Structure dictates the rules by which we play the game of money. Once we have the table set and said, here's the rule book, here's the structure, run it like this. Now we can add strategies into what tax deduction strategies we use on the personal side, not the business side. The business side needs no deductions. The personal side needs deductions, not the business side. The business side is there to make profit. That's why you're in business. You're a for-profit. You're not a nonprofit. You're a for-profit. And my business makes as much money as humanly possible. And then goes to my retirement accounts, which are 100% tax-free. And when I sell the company, it's 100% tax-free. That makes sense to you? The dentist yesterday, he's like, I want to sell my company. Every private company says, I want to sell my company. All right, good. You're going to pay somewhere around 30% in taxes. Somewhere around 30% in taxes you're going to pay, or 0%. But when you sell a company for $20 million, I just had a doctor sell his practice for $53 million. Okay, well, you're going to pay 30%, ballpark, 30% in taxes. Okay, ballpark 30%. Or 0, your choice. And 0 will also allow you to put as much money as you want to in a tax-free account that you can make as much as you want to tax-free for the rest of your life. Or pay 30% and then pay taxes the very next day after you pay 30% in taxes. Whatever money that makes, you'll pay taxes forever. And your children pay taxes. Okay, to understand this, structure is what separates wealthy from contributors. Remember, money can be earned. Wealth is engineered. Show me how you've engineered your wealth. You haven't. Entrepreneurs don't. Because we didn't grow up with it. We feel like the answer was, we knew the answer was not getting a job, let's say, so we thought the answer was business. So we dive into business, we start producing business without understanding anything about money. Our business IQ is very high. Our financial IQ, very low. Very low. And because our financial IQ is low, it's what's costing you all your wealth. Listen to me. I say this all the time to people. If you're right now full-time in business, okay, you're full-time in business, meaning you don't have a W-2 job and business, right? Like, I mean, your company could pay your W-2, but I'm saying you don't have your business and you work full-time, 40 hours a week for another company, and then you have a side hustle. If you right now are full-time in business, meaning you live off of your business, I'm begging you to listen to me. You're already wealthy, but you're on purposely keeping yourself poor. That's a fact. You're doing it on purpose. If you have enough money to run your business and pay your bills, you could be wealthy. You can be wealthy. You already are wealthy, but you're choosing to be poor. You're choosing to be poor. You say, Andrew, I'm not choosing. I'm trying to be wealthy. No, wealth is not created by you making more sales accounts. Wealth is created by you sitting down and for the first time in your life, understanding it's not business that you're struggling with. It's money you're struggling with. And the only reason you went into business was to make this. So let's figure this out and we'll make this work for us. You see, my business produces here my lifestyle, and my business produces my retirement, which produces my legacy. So this engine that makes profit affects this one, and that one. Your business, because of how you have it structured, is also affecting this one, and that one. But because this one, how you have it structured, is going to zero, that one zero, that one zero, and that one zero. Because your structure dictates the rules of the game. So when you change the structure, you'll realize it wasn't you. It wasn't your business. It wasn't your sales. It was the structure that kept you back to zero. And so because we've always been at zero, we just changed the game and said, well, if I don't pay taxes, I won. Matter of fact, the only time you get upset, I want you to show you, the only time you get upset in your business is if you owe taxes at the end of this year. You'll get frustrated. You'll be like, son of a gun, my CPA doesn't know shit. I'm trying to get rid of all my money. I want to be broke. How dare they say that I made a profit? How dare they say that I actually produced a profitable business? I'm here to be broke. And you'll go find a new CPA that knows new tax strategies to take you back to broke and think, oh, thank God I'm broke again. But you won't say that you're broke. You'll say that you won. But your bank account says you're broke. Why? Structure. You're not broke, but you're forcing yourself to be broke because you're forcing to make yourself play a game to keep you broke. I'm not trying to get you to work harder. I'm the first guy in your life that's sincerely trying to get you to work smarter. Like, they always say that shit to us. First, they're like, well, you gotta don't work harder, work smarter. All right, well, how? How do I work smarter? This right here. This is smart. Very high financial IQ. It's smarter. Because I work smart, I'm not trying to create more business. I create a structure that allows the business to produce to where it needs to go in the most cost-effective way humanly possible, so that I always win, so I actually get what I want, so I can produce. When I say I was going to the Grand Canyon, I didn't go to New York. I went to the Grand Canyon. When I said I wanted to create generational wealth, I actually created generational wealth. It wasn't a figment of my imagination. It was real. It's really there. You say, Drew, you have generational wealth because you have a big business. No. I have generational wealth because I had the right structure. When I had the right structure, my business was free to produce. You see, your business is in prison right now, and you're keeping it there. You're keeping it there. Let your business run. Let it run. And when you let it run and not worry about bogging it down with all your negative expenses, and then let it produce the way it's supposed to produce, and it's free to move the money where it's supposed to move the money, and you're not trying to figure out how to get rid of all your money all the time, you'll win. You'll win. At the game of money, you'll win. Why? The higher your financial IQ, money is a byproduct of that right there. It's a byproduct of it. Lower the financial IQ, lower the money. Higher the financial IQ, higher the money. I didn't say higher the business IQ. I said higher the financial IQ. That's why I built Fig Hotel. Why? Because there's floors to it. And until your key card can go to all the floors and you can understand it, you'll never have it. Because you can't delegate wealth. You got to own it. And if you don't own it, no one else will for you. I'm not going to own it for you. I own it for me. I don't own it for other people. You got to own it for you. This is your life. This is your future. So own your structure. and stop taking financial advice from broke people who've never built what you're trying to build. You're trying to build a giant empire that you want. Okay, well, you're going to have to get with people who built giant empires and know how to do it, not from people who have a theoretical concept of what to go do. Not with someone who has read a book and can tell you, well, the book says this. Fuck your book, bro. I'm looking for real street shit knowledge that really freaking works from someone who actually did it. Not theoretical stuff that somebody wrote in a closet somewhere to tell me how to go run a business when you've never ran a business before. You want to tell me how to build a $500 million a year business when you've never built a business over 50 grand. But you're going to tell me how I should structure my $500 million business. You haven't built a business over $1 million, and you're telling me how to structure a business for $500 million. No, I'll go to someone who actually understands $500 million businesses. I don't care that you have a license behind your name. I care what you've produced in your past. Everybody can have a license at different things, just like teachers. It doesn't mean that they're bad. It means I'm not for you. I'm not your avatar. There's attorneys that I work with that we're the same avatar, and they specialize in the things that I'm trying to do. I'm their client. I'm their avatar. I'm not the contributors' attorneys' avatars. I'm not the financial advisor's avatar. I'm not trying to make a mutual fund for 6% a year. I'm trying to create actual wealth and understanding non-correlated assets and how they work together inside of tax-free. Listen, one thing you got to understand, the greatest way for you to create wealth is understanding the compounding of interest absent from taxation. Write that one down. The best way for you to create wealth is understanding compounding of interest absent from taxation. That's wealth. That's wealth. Compounding of interest absent from taxation. When I click on the calculator and I type in those numbers, what is it? That's why it's hard for you to believe it. You're like, oh, that can't be right. Okay, well, do it yourself then. Go get another calculator off the internet and type in those same numbers. What we miss is anytime we've ever looked at wealth, we've never looked at it from a compounding of interest, absent from taxation in our life. We looked at it as an entrepreneur, we look at it of how big can I build my business? We're looking for somehow when I build this business, even though I go to zero every year, at some point my business is going to be worth $1 billion, but I go to zero every year. No, it doesn't work that way. You got to understand money and how money works in your life. And if you can be the CEO of money, you can actually crush. Let me cover this with you. I'm going to take a couple minutes here. I want to show you this. I normally do this on day 2, but I got a little bit of time here. I'm going to do this on day 1. Jordan, change out my screen here. Let me move this side over here. I'm going to go back wall here. It's like this. I want you to understand this. We talked about this thing called family office. To understand what I really do here is with my partner, Eddie, we run what's called a family office. Family office is the highest level of wealth you can get to. When you make a lot of money, you can go search this up. When families make a lot of money, they create what's called a family office. Inside of this, me and Eddie have created our own family office. Okay, Eddie is a 3rd generation wealthy person. He comes from 3 generations of money. First generation. I don't come from money. I came from as a contributor, worked my way over. Me and Eddie have been business partners and on and off for probably 20 years now. I'm 1st generation. He's 3rd generation. He comes from money. I don't come from money. I'm talking to many people like me. You didn't come from money. As you make money, the highest level of money you can get to is a structure called a family office. It's a family office where you have all the pieces inside of what you do. Your tax people, your attorneys, they're all inside your office. My CPAs are in the hallway. My tax attorneys are in my office. My Rob's attorney, they all work directly for me inside of what we're building out. For who? Others? No, really just for me and Eddie. Inside of that, as I build this out, we turned and said, okay, well, what if we take what we have and actually build it out for other entrepreneurs inside of it? What if we took this and help other entrepreneurs do what we're doing and give them the same access that every entrepreneur is looking for, which is the actual structured data shit of how it really works. No bullshit, just true structure. Tell me how to structure, and I'll go do this with you. You as an entrepreneur, I could go do it if someone just freaking tell me how to go do it, help me go do it, I'll go do it. That was me. It took me 15 years to figure this stuff out. I want to break this down so you can see this. I'm going to show you, probably in my opinion, in my career, the best thing I've ever built for others in my entire life, okay? When I started the structure side of helping other people, I broke it down with Eddie and said, what is the cheapest humanly possible way that we could help people that are entrepreneurs like me get to the level where they could truly make money the right way through structure? Meaning having the right pieces in place, the right financial IQ, the right knowing what tax breaks to use, when and how to use them inside of it. We built what's called a family office. I built it out as low as humanly possible if you want to work with us. Everything that you've ever wanted to understand about money from someone who actually does it. There's not one piece that I teach you that I don't personally go do on a yearly basis that our company doesn't structure out and do. We have a ROBS. We have a 1202 structure. We do art. We do all the things that we talk about. We do the Dynasty Trust. All those pieces, that's what we do for ourselves. If you'll change what Mark Cuban said and said, stop taking financial advice from broke people. Come take advice from actual people who've done what you're trying to go do. Inside of here, high level, I want you to understand this. There's 3 levels here, but they're not one or the other. You only need one. It depends on where you're at. I call this the W-2 startup business phase. If you're new to business, you're getting started in business, you're fresh to business, maybe you're a W-2 trying to start your business, do this right here. Do this right here. If you are more of an established business owner, this one's for you. It costs more because you need more. You're doing more than what this person's at right now. But understand, this is this, just at a more advanced level. But there's not a different game. 4 quadrants. It's the same. It's just this one has more stuff inside it, more things to help you as more of an established business owner. If you want to start with this one, I don't care. Start with this one. But I built it to specifically do what you're trying to do. And if you're here and you're a multi-million-dollar business owner, this one's for you. $30,000. Just to be clear, this one has what this is inside of it. They have the same pieces inside of it. It's not that if you start here, that one day you should do this. I'm not saying that. I'm saying if you start here and you're a startup in business right now, you're new to business, this should be all you ever should have to do. Because as I teach you how to do it from the very, very beginning, you don't have to go back and restart shit. So this is where you're at. And as you continue to grow and learn all the stuff that we do here, you can keep adding it, the structure to it. If you're established business and you're already down the road some, okay, there's some work that we got to go do. And if you're a multi-million-dollar business, okay, there's some stuff that you got to fix right away. This year, we can still solve stuff this year for you to make that tax bill disappear. But I don't want you to look at it as that it's a progressive process, that you start here, then end up there, and then go here. No. If you start here, right here, then you shouldn't do that one. You should just do this one. And if you do this one because you're a multi-million-dollar business owner, it will be the same thing that you're getting. This is just more hands-on right now to make tax stuff disappear for you right now. Where this person doesn't need that right now, and this person probably doesn't need that right now. But this person I need help right now. I'm paying taxes this year. I need help to make it go away. All right, we can make it go away. We can do that. It's not hard, but you're gonna need my personal time now. Over here, you don't need my personal time. You need my financial information so you can structure your stuff out the right way and do it over time, but you don't need to make taxes that you got a $400 tax, $300,000 tax bill right now, like this person does, or this person got an $80,000 tax bill due every single year. You don't have that right now, so you don't need this one. And if you'll do what I say here, you'll never need to do this one. Does that make sense to you guys? It's not a progressive upsell through the process. It's based off of where you're currently at, what you need. That's how I built it out. Inside of it, I'm gonna make sure you understand this as I go through here. I built it out through the process. Let me go to this structure slide deck here. Yeah, right here. Think about it this way. If this is the infrastructure side, this is the quadrants that we're going to go through to build out for you inside of it. I mean, look, you can see I've spent one day, and I've made it through 2 sections so far. Not even 2 quadrants. I made it through 2 boxes inside of the quadrants. That's it. That's what I made it so far. Inside of here, there's probably 50 other boxes that we got to go through over time to go through all these, okay? But inside of here, think of this as the infrastructure. If you have the infrastructure, then you need the implementation side. The implementation side is the family office. A family office is the pieces of the puzzle where everything's pulling on the same rope. Everything, your tax person and your investment advisor and everybody understands where you're headed with everything, and they're all pulling on the same rope. So we just look at it from a simple standpoint of infrastructure and implementation. Because we can talk about all this cool shit that you could go do, but if you never implement it, it's not going to help you. So we got to figure out how can we build it so that the infrastructure can help you with the implementation side, can help you get to the infrastructure that you need. Inside of here, there's several things I'm going to do for you. The first thing, super important, is I told you this earlier. I have a private app community that all the members are inside of. Everything from single moms on an Etsy business to $500 million a year companies out of New York City. There's that app. And then this app is where I break down every last piece of what you're looking for inside of wealth, the true wealth of what a true entrepreneur who actually does this shit full time, how it actually works for you. Inside of Structure Got Your Business for you. The first thing I want you to do, if you want to work with me, I'm going to take you to what's called a 2-day tax-free lab. So inside of the tax-free world, when I am doing my accounts, this person right here, his name's John, is probably the person I talk to more than anybody else, maybe except for my wife and Eddie, my business partner. Maybe John. It's a daily basis. I talk to him on lunch. I talked to him today about stuff that I'm working on. John comes from the #1 self-directed custodian in America. They're the largest custodian in America with $60 billion plus of investment capital from wealthy people inside of their one office. They don't invest it. Let me be super clear. Remember, they don't invest your money. They're just the custodian that holds it to allow you, self-directed, to go move that money. They're the largest in America. They're one of our business partners because of all the accounts that we open up. John's the vice president of that company, moving into the CEO, future CEO role of that company. I bring him in for 2 days in a micro version of understanding and breaking down the 4 tax-free accounts you can open there and how each of those accounts works for you and what it does, how you can and cannot use it, what you can do, what you can't do. It's like the legal side of it so that you understand it. Remember, you're going to be the CEO of your money. You got to understand it. So part of it is pushing that financial IQ higher. So I bring in John to break down the legal side of it for you at the largest tax custodian company in the world, breaking down step by step the 4 tax-free accounts for you. If you want to open tax-free accounts, you can open them right there. If you don't want to open them, you don't have to open them. You don't open up one, open up one. You don't open up 17 accounts, you can open up 17 accounts. It's up to you. I'm not going to ever make you do anything. I'm going to show you how to get from a contributor to a creator. And along that path, there's certain things that you have to go do. You can't do anything that I told you until you open up tax-free accounts. Until then, we're just talking about theoretical bullshit that never takes place in life. I'm not here to talk theoretical stuff to you. I'm here to help you structure your business to create the life that you really want. You can do it. You can have it. You can actually, most of you are actually already there if you'll stop on purposely screwing yourself over. You're already there. You just gotta structure it the right way. It's truly time, like work smarter in 2026, just do it smarter. You don't just do the same thing you're doing, just smarter, less harder, just smarter, and you'll make money. This is a tax-free lab, 2-day class, 2 days, 1 day on 2 accounts, the second day on 2 accounts. The legal structure, how to do them. If you want to open them, you can open them. They're a licensed financial custodian. You can sit down with them and open it on that day of the call. From there, I'm gonna give you what I call a 1-day tax class with me. This is basically where I take what I do with private clients that are $250,000 a day. I'm going to take those that day, and I'm going to bring up real life people from the audience live in this room, virtually, and I'm going to break down their entire tax structure for them as if they're a private client in front of everybody so you can see it. Okay, I can't do the things for you, but I can show you. Listen, I need to know this. As I collect this data, okay, we're going to structure it this way. We're going to do this right here. We're going to do this right here. I do this so that everybody on the call can copy and paste what I just taught that person, okay? So I'll do businesses that are like under 500K or less. Then I'll do businesses like under 2 million or less, and I'll do one that's 2 million or more. So I try to help you if you're any of those sections right there. On the one-day tax architect, I basically break down a financial private client, but I do it live in different brackets to help you know, here's the structure that I would do if I were you. Here's the components that I would use if I were you in under 500K, under $2 million, above 2 million, do these pieces right here. It's a live example, tax architect day, that I charge $250 for. I do it in here virtually for the class as a whole, and then you figure out what bucket you're in and copy and paste that shit. The $250K is because people want me to do it for them. They want me to build it, manage it, oversee it. They're focused on their business, and they just want someone to say, I trust you, build all this, make it happen for me, and that's it. That's what they're paying for. They're paying for my one-on-one services to make it happen for you. If you'll just build it, you can do it yourself right now, okay? It's a one-day class, same thing as a private client, but broken down in that one-day class. There's a big thing here, a word I want you to understand, and the word is access. It's access to. So inside of here, as we go through here, the main word I want you to understand is access to. What wealthy have is access to different stuff. They've got access to things that contributors don't have. That's a fact. That is a 100% truth, okay? All I'm trying to get you to do is have access to what the wealthy have. So inside of here, we do, at our family office, we do 3 calls a week for you. I don't need you to go to all 3 calls. I want you to go to any call you want to, anytime you want to increase your financial IQ, okay? So inside of here, I do is called Multiply Mondays, because you got to create it, you got to keep it, and you got to multiply it. So here's what's great. Inside of the call, every Monday, one of these 4 people are going to be on. Every month, you're going to hear from a true CEO of a company that manages high-level, rare, collectible gold coins. The company that has 41 coins that made 16 to 26%, there they are. They're there. You can use them. They'll be on the call every Monday. We talk about how to multiply your money. I bring in my personal crypto expert. You can use them. I don't care. This is when I buy crypto, I'll buy whatever he says. Because I'm not a crypto expert. I'm a financial CEO of my money, but I'm not an expert in gold. But Forrest, expert at gold. That's all he does. That's all he does. Carlos, if I invest in multifamily, that's who I use. If I invest in my hedge fund, that's Jeff. That's who I use. Every Monday, one of those guys comes on for an hour and teaches you how to invest in gold or how to invest in crypto, why, what to look for, what not to look for. Be careful with this. Whether you invest with them or not is irrelevant. It's just how it works. So your financial IQ can keep going up. So understand, I'm going to bring in, just like a family office does with real wealth, I bring in my own personal team. All those guys right there work with me in my own office for my own investments, all right? I just give them to you. Instead of you having to go try to find everybody out there, here they are. Use anybody you want to go use. You can call them yourself. It's okay. You can talk to them if you want to. It doesn't bother me. But I want you to have the information of how it works. We'll go through, on Multiply Monday, we'll go through the precious metals. We'll go through hedge fund investing. We'll go through crypto investing. We'll go through multifamily investing. Again, I'm talking about people that, Carlos, 5,000 plus apartment doors. Not someone who last year started trying to do apartment complexes. 5,000 apartment doors. Hundreds of millions of dollars of apartments this guy owns himself personally with his own money. All right, that's where I put my money at. You can put your money there if you want to, don't if you want to, but learn how to invest in multifamily. I'm trying to give you the financial education piece, access to someone if you want to go use it, or go get someone else to go do it, but learn how it works and then go get someone. Don't just go randomly get something to go invest in capital. Number 2, we do tax-free Tuesdays. Tax-free Tuesdays. So Multiply Monday, tax-free Tuesdays. This is John. Comes on, and we do structuring of deals. How to structure your Roth structure. Entity structure. What is it? S Corp, LLC, C Corp. Why to use them? When to use them? These are weekly classes that we'll teach. This will be a 1-week class, or it is on 1 week on a Tuesday, tax-free Tuesday. He'll teach that for about 2 hours. He'll take live Q&A. Then he'll do one, how to do private money lending out of your tax-free accounts. How do you do small money movement out of your tax-free accounts? He'll take real life members who are doing a real life deal together. And he'll say, okay, here's this person, and they're going to move this money to this person over here. And here's the deal structure they're going to go do. All right, here's the paper you're going to fill out. He's going to use his HSA account. He's going to move the money here. All right, here's how the paperwork works on this type of deal right here. And you can learn how to actually do the freaking deal on a real life deal with someone inside the class. This is Tax-Free Tuesdays. Every week they teach a new thing for you to make sure you can consistently push that financial IQ up. And then Wednesday calls are with me. It's Engineering Wednesdays, Wealth Engineering Wednesdays, because remember, wealth is engineered. It doesn't happen by happen chance. It doesn't happen because you built a business. It happens because you sat down and you engineered it on purpose to happen. So every Wednesday I get on and I do different strategies with you. I'll do the art strategy with you, and I will break down the entire, I'm doing one on Tuesday, and I show you the art that I am personally buying. And then say, if you want to go buy this piece, you can go buy this piece, okay? So I'll buy a piece for like $5,000. In a couple years, as long as it goes up in value, I should be able to donate it for like $200,000. I'll donate the art for like $200,000. I will bring my art guy in on the piece that I'm buying. You can buy the same piece you want to. You don't have to go find anybody. You can just go, I'm going to get this piece. Here's why. Here's the structure. Here's why I'm doing it. Here, based off of this information, I'm not telling you to go do it. I'm saying, here's why I'm doing it. If you're going to go do it, go do it. You can call him direct. You don't go through me. I'm going to actually provide you what you need. And if you're going to go do it, go do it. Listen, this is how wealthy people play the game, is that we use art strategy to create on charitable donations up to 30% of our entire tax bill wiped away off of art strategies. Art donations. I'm assuming you probably have never done that one before, because you were trying to do a car for $6,000, 6,000 pounds to go into debt to do a strategy to save money in taxes. It's not what we're doing, man. It's not the process that we're doing. We're playing a game at a much higher level than you could ever imagine from any of the CPAs you've ever talked to. Okay, so I'll come on this Wednesday, I'm doing an art strategy deal on a real life deal that members can go buy or not buy. It's members only inside of it. I'll do what's called the accountable plan. Again, if you're not using the accountable plan, I don't even understand it. There's not one, it's free money. So 1 week I'll teach the accountable plan, around $50,000 a year of tax-free money. So I want you to think about this. When you hear $6,000, just understand, come spend a week with me on Wednesdays for 52 weeks and watch how much money you're worth at the end of 52 weeks. Forget investing, forget money movement. Let me just take your business, get you structured the right way on the tax strategy day, and then sit here and teach. Like every week, I'll just teach you this stuff right here. And if you need a $200,000 donation deduction, I'll show you how we play this game. And every year you can do it. Every year. So $6,000 is not, just understand, when you do this, you'll make this money every year. You'll be making this money. That's $50,000 deduction from your business, $50,000 of income to you, 100% tax-free. It's the best of both worlds. There's 4 main strategies you got to do. This would be one of them. You deduct it for your business, pay yourself over here. Family, LLC, management company, accountable plan, $50,000 a year, tax-free money. It depends. You can have 30 grand, 80 grand. It depends on where you're at, but potentially around 50 grand a year, every single year. Tax deductible, paying yourself 50 grand or 40 grand, where the number is, tax-free to you. I'll go through 1 week, the Augusta rule. Again, I don't understand. It doesn't make logical sense why someone wouldn't use it. It's free money. The IRS is incentivizing you and saying, here is free money. Free, you can take it. You can have it. And what do? No, I'm going to write off stupid shit. Listen to me. If you don't change, AI is coming after you in the IRS. It's a fact. If you don't change right now, you're going to get audited. It's going to cost you a ton of money. The only thing I want you to do is play the game by the law. That's it. Everything I'm going to teach you, like you saw today, I give you a tax code for it. Why? Because it's created by the wealthy. Just follow what they do. This is 22 grand a year, every year. Every year you'll make that. Accountable plan, if you hit the 50 grand level mark, 40 grand, 80 grand, I don't know if you're going to hit, but around there, tax-free every year. You find me a better ROI on your investing. I dare you. I dare you to find a better return than you understanding money from someone who actually plays the game of money. Let me guess. How many do this one right here? Tax R&D credits. My guess is your CPAs never even brought it up to you. R&D credits. I have a farm. I make blueberry honey. R&D credits. If you understand what true R&D is, I have a client right now that made a cookbook, and she sells a cookbook. Just understand, everything that she used to make that cookbook, to research how to make that cookbook, I mean, as far as like what ingredients and what recipes she used, that's R&D. Yes, it's deductible, but that's R&D credits. My guess is you play the game of R&D credits. Okay, well, that's just free money you're losing. Go look up how many corporations, like the corporations you invest in, use R&D credits. Go ahead. Yeah, they're for you too, but we don't ever use them. It's easy, 20, 30, 40. I just had my private clients get $300,000 in tax credits. That means the government gives you a $300,000 credit on your tax bill. So if you owed $1 million, now you owe $700 because they just gave you $300,000. A credit is worth 4 times a deduction. So credits we want at a high level. There's only about 4 credits we can use. R&D is the best one out there. I'm going to teach you another week, vacation homes. How do wealthy people buy vacation homes and deduct all this money? Okay, it's potential worth about $300,000 for you. At the end of the year here, I've got several clients buying vacation homes right now in Florida. I should become a real estate agent down here because I could just sell oceanfront property all day long and make a ton of money on the side. I should write that down. That's a good idea, okay? Inside of here, just understand, it's all these vacation homes that you can buy, that wealthy people buy, and then deduct all that shit. Not just 1 year, year after year after year. I'm going to teach you another week, family pension plans. Family pension plans. How to set up retirement out of your family management company, remember that family management company, to be able to set up family pension plans, deduct all that shit so that you don't pay taxes on it, and save about $250,000 a year in family pension plans. Or you say, I don't make $250,000 a year. Perfect, let's do it for $25,000 a year. Whatever you want to do. Just understand, there are unlimited. I probably have close to 50 things that I teach week after week after week after week that you've always wanted to know how the wealthy do that shit. For real, we do it. Yeah, I can tell you. Why? Because I do it. I do all this. Everything I just showed you, I do all those. I have all those. Every year I do them. I am freaking from an entrepreneur to an entrepreneur begging you for once in your life, bet on yourself. And when I say bet on yourself, it's your financial IQ. Listen, I can teach it to you, but I can't understand it for you. So if you don't want it, then no one else is going to do it for you. You got to understand it for you. You can't delegate this shit. You could have been doing this for the last 15 years of your life if you wanted to. We didn't, and no one told us. And we hired a CPA, we hired an attorney, but no one told us shit. Right. That's like 5 things there. I probably do 50 of them. Everything from captive insurance, equipment leasing, all the way up to how to buy private jets. One of the weeks is I'll break down how to buy private jets and write off the entire thing and then lease it back. Okay? Everything from massive all the way down to an HRA plan. How do you write off and then get paid for buying your over-the-counter medicine, your Tylenol, your sunscreen, your chapstick? How can we do it? How can we set up an HRA plan where we get like $10,000 a month, $10,000 a year, tax deductible from our company, and then get $10,000 paid to ourselves, tax-free? So just understand, if you'll use like the 4 strategies that I'll teach right off the bat, the first month I teach 4 strategies, bang, 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 to all the onboarding new people. I'll teach 4 strategies right away that are the 4 most simple strategies that you should do right now this year to put about $100,000+ in your pocket. Deduct it from the company, tax-free to you. So before you ever take a W-2, before you ever take distributions, let's get all the tax-free money out first before you do anything else. So think about that right now. Right now, most of you, depending on how big of a business you are, you could pay yourself upwards of $100,000 a year, 100% tax deductible, 100% tax-free income. How often? Every year. By doing what? Follow the law. It was created by the wealthy for the, just follow the law. That's it. For $6,000, find me a better return on investment that pays you year after year after year after year. Or stay where you're at. But what if there is a way to actually get what you want? There is. And your return is yearly. Because once you know how to do it, you do it every freaking year. For how long? Until you die. or don't learn it and never do it, or Google it. But if Google was your answer, you'd have already chat GPT'd it and figured it out for your life. Yeah, you can't chat GPT your way through this one. Access is the key word. Not only access there to the education training side of it, I'll give you access to our private equity deals. So me and Eddie do our own private equity deals. We're doing a massive business. We're creating right now business taxes in our Checkmate, which is our tax company. We're turning our Checkmate tax company into an AI, because the only way that we could ever compete when the IRS moves to AI, the only way for us to ever compete as entrepreneurs again is to have a tax company that is AI driven. That's it. So we are launching an AI driven tax company. Listen to me. That is a private equity deal. We launched it to our members only, private equity. Invest out of your personal accounts, Roth, whatever you want to. You can invest inside of it. We structured it in a 1202 structure, which means you as an investor, when we sell this company one day, you get all of your profits up to $15 million tax-free, personally, tax-free. That's called hedging your losses. Like you move into a deal with hedging against immediate taxes. Because why? Because the people doing it understand how the game is played. Why would I set up an AI company not inside of a 1202? You'd be out of your freaking mind. The whole purpose of a 1202 structure is for that shit. So our investors get to do private equity deals just like that. Structured the right way so they benefit off of it. Inside of this deal, it's a tax discount conversion deal, which means you could take your 401k, invest from your 401k, and discount about 55% of all your money tax-free now. Remember I told you that deal? That deal is built for it. How the discount conversions work? Yeah, we build the deals for exactly what wealthy people do. Like, my God, if you would just play the game as a wealthy person, your life financially will change through structure. Structure. Not more sales, structure. Now, if you put more sales on it, it's gasoline. Structure will change it for you, though. Access to multifamily deals. You don't ever have to go look for deals. You don't have to go find deals. I'll give you the exact same deals that I put my personal money in, my own personal money in. If you want to invest in it, great. If you don't, great. You don't have to. But if you've ever wanted to actually make real freaking money in real estate, like multifamily, with somebody who puts their own personal money into it, not I do a deal and raise money and then I get all the profit from it. No, I put my own money into it as an investor. Just like you. I invest alongside you with my own money. So you can do it or don't do it. Understand, I'm not doing this to buy apartment deals. Like Grant Cardone, great friend of mine. But Grant's doing it to raise money to buy apartment deals, which is great. I have nothing against it. I don't do that. I'm buying my own apartment deals for myself with my own money. And if you want to invest with me, great. And if you don't, it's okay. I'm buying it either way. I don't need you to buy it. I'm buying it either way. If you want to buy it, great. Invest with us. Not great. Either way, it's okay. But if you've ever wanted just pure access to the deals that we do, this is it. Access to tax-free cryptos. My tax-free crypto guy. We own the platform. To be clear, if you go to taxfreecrypto.com, that's me. I own that platform. I own the only tax-free investing crypto platform in America. It's mine. Why? Because I got to own it. I mean, I have to invest in crypto. I want it tax-free. I'll give you access to my hedge fund. 23.6% a year for the last 13 years in a row. Or put it somewhere else. I'm okay either way. It's not going to change my life if you put in or out. I'm just giving you access to stuff the wealthy have. If not, you could go get your own hedge fund. You'd probably be putting $1 million, 500 grand minimums inside of it. Okay? Or you can, if you want to, invest in our hedge fund. Or not. I'm okay. I want you to have access to the whole buffet for the first time in your life. No strings attached. Do it or don't do it. But you have access to all of it. More importantly, I want you to learn all of it. That's why I do the trainings first so you can learn it. Invest over here or go get your own, invest over there. I'm happy either way. I just want your IQ to go up because if your financial IQ will go up, your money will follow with it. It's how it works. Access to rare gold, no problem. You get straight access to the largest rare gold supplier of coins. They've won the award 6 years in a row as the best gold market investors in America. You get direct access to them. Special access, like behind closed doors access to them. Why? Because, listen, if you go to them by yourself, you're one person. When we go to them with thousands of investors, bro, They bend over backwards for us. They show up at all our events, have tables, and want to talk, want to get to know the people. Why? Because we're not one person. We're 4,000 plus strong entrepreneurs that have access to capital that's ours, that want to invest in certain things. It's like flipping the script. Instead of you having to chase it, they come to you. You're in charge, man. You're the CEO of money. I'm going to provide you access to all the stuff that I personally, listen to me, there'll never be a deal that I ever bring you that I personally don't have cash inside of. Just understand that. There's no such thing. If I bring you a deal, it's because I have my own money inside of it. If you want to do it with us, great. Mainly, I want you to understand it, though. I want you to understand it, financial IQ. I want that financial IQ to be very, very high. This is what we call self-directed family office. It's a one-year membership, $6,000, 1-year membership inside of it. Okay, that's the process of how it works. Every year after that, it's $4,000 every year after that. So you do the first year, you want to stay, it's $4,000 membership. After that, year after year, you get access to all that stuff. If you say, I want to go shop around, be my guest. It doesn't exist. There is no competition. Go anywhere you want to go. You'll never find anything like this has ever been created. It doesn't exist. Why? Because I was you as a contributor. I made it across, finally, after 15 years of doing this shit, flying across the world trying to figure it out, spending millions of my dollars trying to figure out how this shit works. Once I figured it out, then I turned around and said, here, look, you guys can all do it too, on this side. Understand, you go and shop around. It's okay. It doesn't exist. There is no competition for me. I really do all this stuff every single year of my life. There's $6,000 membership, and there's $15,000 membership. You say, Drew, what's the difference? 6,000 and then 15,000, you get everything that I just walked through. So the 6,000, you get everything that I just walked through on all that stuff that we just did right there. That's the $6,000 membership a year. Year after that is $4,000 a year after that. $15,000 is the same. You get exactly what I just covered, all of that. So everything includes everything I just covered. It's not something different per se. It's the same thing because the game is the game. The structure is the structure. I can't teach a different structure. It's the same structure. The extra stuff that you get, though, would be we have a in-person live mastermind. That mastermind is a $30,000 a year mastermind, okay? It costs $30,000 a year to be a part of that mastermind. In $15,000 membership, I'll give you that mastermind right there for 1 year, okay? So you get access to that mastermind. It's 2 events a year. I'll give you access to that $30,000 mastermind for 1 year at the $15,000 level. So you get everything that 6,000 gets, including inside of that, I have what I call 2-day workshops that I teach or my personal team teaches that are live in the office, okay? So those events that are live in the office, you get virtual access to all those events. So our live membership that we do gets live access to those, but these live 2-day workshops, I will give you virtual access to all those workshops. So we deep dive into business succession. How do you pass down your business to your children? How do you do generational wealth? Another 2-day workshop in April is how does asset protection work? I bring in my asset protection attorneys. You get 2-day workshops. All that is included. Corporate structure workshop is included inside of all of them. We do 2 or 3 of those per year. We do with me and my personal team, just teaching all day long on one topic so you can understand it. I'll give you virtual access to all those different classes that I teach inside the $15,000 membership as well. So everything is $6,000, plus you get the $30,000 mastermind included in that for 1 year. You get that included in it. Plus you get the all the 3-day, 2-day workshops virtually attended, all the 2-day workshops that I deep dive inside of all those things. Plus I give you a lifetime membership. Lifetime membership. There's no more yearly fees for you. One-time fee, $15,000. You get lifetime membership inside of our community called a company lifetime membership. On top of that, you get the mastermind, 1 year of live access to our live mastermind with other entrepreneurs that do tax-free investing just like you. It's a great place to meet small money movement people. We do whole sections of small money movement while we're there. Inside of it, you get access to the office here, plus you get the 2-day workshops that we do virtually. You get to attend all of those, plus you get lifetime membership, no extra yearly fees for you for $15,000. That's why, understand, the training is the same information for 6K or 15K. It's the same information. The 15K is because you're more established business owner. just do the whole thing up front. You get lifetime membership, plus you get more in-person stuff, and you get deep dives on the business structure stuff. I'll be teaching that stuff throughout the year on a call here or there, but the 2 days just go deep dive and solve it all at one time with you on the virtual workshops. Plus you get the lifetime membership included in it. I'll give you a couple bonuses on both sides. So just make sure you understand this. This includes 2 people, okay? So it includes 6K, at 6K or 15K, it includes 2 people, all right? So it's not, you can bring your guest to it. It can be your, not someone that you just met on here. It has to be like your actual business partner. It has to be your husband, your wife. You want to bring your children to it, the event, you can do that. But make sure it includes 2 people for you. So it's not, you got to base for you and your husband or you and your wife. The 6K includes 2 people. 15K includes 2 people. One last bonus for the $6,000 group. I want to make this as much as a no-brainer as possible for you. So for the $6,000 group, on top of that, I will give you an extra year for free. So you'll get 2 years for free inside the 6K. That's $3,000 a year for the greatest financial IQ that you've ever had, laid out in a way that you can clearly understand how all of it works. If you can beat that price anywhere, shop around all you want to, just don't come back. It's $3,000 a year, 6K up front. You get it for 2 extra years on that level right there. 15K, lifetime access, plus in-person events, plus the workshops included inside of it. This is the membership we have here. We have 2 memberships. We have 6K and we have 15K. Give me the back wall really quick. On the back wall, I just covered the 6K right here with you, and I covered the 15K right here with you. Tomorrow, I'll cover this one right here. Just understand, for those that are multi-million dollars in this room, this right here will be the same as the 15K, just personal time with my team to help build it out for you. That's really all that is right there. I'll go through it in depth with you tomorrow, okay? But if you want someone to help build it for you, we can do that for you as well. I'll go through that tomorrow with you to make sure you understand how it works. This right here is 6K, 15K inside of it. Looking at it broken down for you. This is what the 6K includes, all the stuff I just walked through with you right here. This is the 15K. It includes all that, plus these extra pieces right here for it. The way that we work through here is we have in trainings like this, I do this training right here 2 times a month. I do this virtual training right here, okay? We set aside 30 slots per month that we fill up, okay? That's 30 slots per month. We fill these slots up, okay? The reason is because we can only onboard so many freaking people at a time. We have an entire 4-week onboarding process for you where I have to do a deep dive training to immediately in those first 4 weeks make sure that you can make tax-free, tax-deductible, $50, $100, $150,000 right away to make sure you make all your money back of your $6,000 or $15,000 right away. I got to do that every single time we do an onboarding process to help the members out. So we only onboard 30 people per these virtual events. If there's leftover, we just onboard them next month. So it is not unlimited access. I don't have the ability. This is a process that takes time to onboard everybody through the right process to make it happen. So we onboard 30 people a month inside of here. When the 30 slots are gone, it's okay. We just wait till next month, and you can onboard next month inside of December. This right here is you can do it right now. As long as you're in the first 30 that goes in, you onboard this month. If not, you go to wait list and you onboard the next month, and then the next month, the next month. We have people who onboarded this month from last month. Those 30 slots we sell out because we do 2 of these events per month. We sell those 30 slots out every month. We onboard again, and then we started the process over again, onboard next month, and onboard next month inside of it. If you want to join through here, if all you have to do is text your strategist. Also, my team sent me out the 5 resource accounts, the 5 non-recourse loans providers out there. If you guys want those, you can text your strategy as well. But if you want to sign up for this today, if you want to sign up today through this process right here, you can text your strategist right now. After the first 15 slots are gone, because that's what we have available for this event, 15 for this one, 15 for the other one. It's 30 total, not 30 for this event, 15 for this one, 15 for the next event this month right here. So once those first 15 slots are gone, that's it. 15 slots are available. If you want to do it, text your strategist. They can help you sign up for the process. If you need to make like put money down and then pay the rest next week. Like they can work the details out with you. If for some reason you can't, or you just split cards, you need to put 3 on this one and 3 on this one, you can do that. They can work all that stuff out with you right away. So if you want to sign up, I need you to text your strategist, get signed up right now for this. The first 15, tomorrow when I come back on tomorrow morning, I'll tell you how many people signed up, and that's what we have left. So if 8 people signed up or 6 people or 9 people signed up, okay, well, that's what we have left. I'll tell you first thing in the morning when I start tomorrow morning in class. Text your strategist right now. If you want to sign up, if you need help with kind of a payment plan of paying right now, not a year-long payment plan, but if you need help right now through a piece of it for extending it something, just let them know. They'll help you out. I want to work with you. So I built this to work with you. Again, find a better return on investment. I freaking dare you to find a better investment than you investing in your financial IQ and then me personally in the first 4 weeks, making sure you know how to make 50, 100 grand tax-free back in your own business. Your own business. You'll just make it back this year if you want to. This year you could go do it. You still got time if you'll do it this year. You can do it through the onboarding process. You can do it. Listen, there's no way you lose in this shit. It's just a matter of, are you worth 6 grand? It's not a matter of, can you make 6 grand back? It's a matter, are you worth 6 grand? Is it worth 6 grand for your financial IQ to go up? That's the question you can answer. I can't answer that for you. You got to determine if you're the CEO of your money, not me. Tomorrow morning, I'm going to start going through private family foundations. I'm going to show you how the wealthy use private family foundations. I'm going to go through art. I'm going to show you how art works and how they donate art to get 30% of all their taxes wiped away with art. I'm going to show you games that they use in high-level stuff, and then I'm going to dive into the estate planning side. I'm going to go through the personal side with some strategies that we use, and then I'm going to go on the estate side. I'm going to show you how family bank works. I'm going to show you how family offices work in the South Dakota, how do you set those up, the trust, what trust do you use? I'm going to show you that tomorrow as well. Listen, I hope you guys had a great day today. I love teaching this. I love helping you. I look forward to working with 15 of you guys this month and hopefully more next month if those slots go away. Hopefully we can work with more of you. I love you guys. I can't wait to see you tomorrow. Be back tomorrow. Text your strategist right now. They can help you out. Get signed up. Once those 15 slots are gone, those 15 slots are gone. I love you guys.